A new retirement reality is staring every Singaporean household in the face, and it is 25 years long. I'm Angela. I run forensic numbers on SGX dividend stocks, REITs, and CPF strategies, so heartland retail investors don't have to guess. Last week, my daughter asked me how long our money actually needs to last once the monthly paychecks stop. I tossed out a quick number off the top of my head, but when I sat down and ran the spreadsheet properly, the real figure was far larger than my initial guess. That gap between what we assume and what the arithmetic demands is why we are breaking this down today. Quick one before we get into it. Longbridge is running a special National Day promotion this month. And if you sign up through my channel, there's an exclusive $100 on top of it. Here's how it works. Deposit and hold your funds. And every day through day 9, you'll collect a piece of a top stock worth $6.10. On day 10, you get a shot at a lucky draw to win shares of selected US stocks, worth anywhere from $6.10 to $610. And if your deposit hits $10,000, that's when the extra $100 cash kicks in. Full terms and the regular welcome rewards are both pinned in the comments below. Worth a look if you're already using Longbridge or thinking about it. Alright, let's get into today's numbers. The life expectancy shift comes down to 3 hard numbers. A Singaporean turning 65 today can expect to live another 20 years on average. By 2065, that runway stretches to roughly 24 years. That is 4 additional years of retirement you must fund from day 1. 20 to 24 years without an active salary is longer than many people's entire working careers. Retirement is not a quick sprint, it is a multi-decade drawdown. Why the save until 65 mindset fails is straightforward. The old model assumed you work, build cash, retire at 63 or 64, and rely on basic savings to carry you across the finish line. But when retirement stretch 20 to 25 years, static cash plans run dry long before you do. Singapore raising the official retirement age to 64 is clear confirmation that the old baseline math was already stretched thin. Family support structures are shifting across Southeast Asia. The share of our population aged 60 and above is set to nearly double by 2050. When fewer working-age adults support an expanding base of retirees, leaning entirely on children for retirement living expenses is no longer a viable financial plan. This is not a lack of love or family care. It is a structural population math problem. Turning statistics into personal reality is where most people get uncomfortable. Macro trends and demographic charts feel abstract until you calculate your own household burn rate. The real horizon for retirement is not a fixed savings trophy. It is a living 20 to 25-year financial runway that requires ongoing cash flow. Retirement is a runway, not a finish line. If you only focus on hitting a lump sum target on your final working day, you run the risk of running out of runway midway through. A 25-year stretch demands that you transition your mindset from building a static pot of savings to engineering a continuous, durable income stream that lasts 2.5 decades. 20 years looks very different depending on which end of life you look at. When you raise a child from infancy to age 20, you clearly see every transition, cost increase, and life milestone. Yet, when people plan 20 years of retirement without a salary, they reduce that entire lived human experience to a single flat number on a spreadsheet. We cannot treat 2 decades of life as a static snapshot. The power of consistency consistently beats trying to time market swings. Sitting on the sidelines waiting for the perfect entry point creates severe cash drag. Cash sitting idle in bank accounts, earning minimal returns, will not fund a 25-year runway against compounding inflation. Small, systematic, recurring deposits beat market timing every single time. Auto-enrollment systems around the world prove why default behavior works. Australia mandates retirement contributions, while the UK automatically enrolls eligible employees into approved pension schemes. Singapore uses the exact same default-on structure with CPF and regular savings plans. When investing happens by default, inertia works in your favor rather than working against you. Diversification means more than just picking different asset classes. It is not only about where you invest across dividend equities, bonds, and REITs, but also when you deploy capital. Spreading your deposits across 12, 24, or 36 months removes the psychological pressure of trying to pick the absolute bottom of the market. Adjusting your risk profile across life stages is essential. In your 20s and 30s, your decades of future earnings absorb market corrections, allowing you to take on higher volatility. By the time you reach your 50s and 60s, your runway shortens, meaning a severe drawdown hurts significantly more. A portfolio built for a 3-5-year-old is not designed to support you at 58. Where most people get stuck is converting basic knowledge into practical execution. Understanding compounding interest is easy, but actually building and rebalancing an allocation month after month is difficult. Surveys show over half of retail investors want structural support because managing risk, asset accumulation, and future drawdown rules create severe decision fatigue. Managing multiple financial buckets is an operational hurdle in Singapore. You have CPF Ordinary, Special, and retirement accounts, your supplementary retirement scheme, and your personal cash brokerage accounts. Each bucket carries distinct tax rules, withdrawal caps, and investment boundaries. This complexity often leads to inertia, leaving too much capital parked in idle cash. Good intentions will always lose to an automated system. Decades of discipline fail if you rely solely on willpower and memory each month. A simple, recurring monthly transfer that executes in the background removes friction and outlasts complex tactical trading strategies every time. Volatility and global uncertainty will always be part of the economic backdrop. High sovereign debt levels, stubborn inflation, and geopolitical friction mean market conditions are rarely perfectly calm. A portfolio designed to function only in peaceful bull market conditions was never properly diversified to begin with. Time in the market remains the core engine of compounding. Attempting to panic sell before bad headlines hit and re-enter right at the recovery almost always fails in practice. A resilient income-generating portfolio is built to endure volatility, not run from it. Time in the market remains the core engine of compounding. Attempting to panic sell before bad headlines hit and re-enter right at the recovery almost always fails in practice. A resilient income-generating portfolio is built to endure volatility, not run from it. Reframing the 25-year horizon is about confronting the hard numbers today, rather than discovering a shortfall at age 75. A dependable automated framework operating over 2 decades is far superior to an overly complex strategy that you abandoned during the first market downturn. What you can do next comes down to 4 concrete moves to turn a 25-year horizon into an actual working system. First, audit your cash position immediately to see exactly how much capital is sitting idle earning nothing. Second, set up or increase your automated recurring monthly deposits so regular investing happens by default rather than relying on willpower. Third, revisit your risk mix periodically so your asset allocation shifts systematically as your life stage evolves. Finally, if managing multiple buckets feels overwhelming, use automated platforms or advisory tools to remove the burden of constant manual decisions and eliminate cash drag for good. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The presenter is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the presenter and do not necessarily reflect the views of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.